Okay, good morning, everyone. I'd like to welcome you all to the Daily Energy Markets podcast. It is Wednesday, April the 16th. I'm delighted today to be joined by Narendra Taneja, India's leading energy expert, Michal Midan, head of China Research Program at the Oxford Institute for Energy Studies, and Paul Horsnell, head of commodities research at Standard Chartered Bank. Thanks so much, everyone, for joining us. Paul, perhaps I can go to you first to give us a bit of your perspective on what's happening with all these commodity prices and markets in the last week or two. Clearly, quite a significant reaction from oil prices and other commodities to principally the tariff talk emanating out of the US. Have we settled now into a new range for these prices, or do you think it's temporary?
No, I don't think we're in an equilibrium at all yet. Obviously, there's been a lot of risk off. There's been a lot of money leaving commodities generally. There was the greatest amount of net selling ever for crude oil in the week following April the 2nd. So it's not an equilibrium. It's still seriously out of equilibrium. Still seeing the funds and CTAs pretty much match short crude oil, more positive on other aspects, but certainly not an equilibrium. If anything, technicals are probably the better guide to very short-term movements. There's a lot of important sort of Fibonacci retracement levels close to roughly where we are. So you can see why the market is sort of perhaps very short-term relying very much on its technicals, knowing that the amount of uncertainty particularly on the trade side is so great that there's nothing permanent about this. This is just where we have landed, but I wouldn't back anything out of it as a market signal yet.
Okay, and so I mean, would you say then, therefore, this is not the end, but is there much further downside, for example, for oil prices at this stage, or wait and see? It's basically in a wait and see mode.
Again, that depends on information flows, but I think from this point, I mean, the reasons for optimism would be that the funds are maximum short, so
Only way is up. Yeah.
It's very much biased onto one side, and these are rather different circumstances. I mean, normally when there is a market panic, there is some immediate disequilibrium. Demand has fallen away, or there's excess supply on the supply side. That's not really the case here. Demand's actually pretty good. First quarter came in about 1.5 million barrels a day up year on year. It's certainly not down as of today. And even through Q2, and this is why the OPEC Plus move, I think, was quite important. It's not going to build up any great surplus, at least in Q2. Still looking for a deficit through Q2. Inventories are low. There's still backwardation at the front of the curve. So it's an unusual market. People are very worried about the future, but the short-term indicators, perfectly okay. It's not a massive, great disequilibrium. I see lots of talk about, oh, there's a glut. There isn't a glut. If there was a glut, inventories wouldn't be low and falling, and the market wouldn't be in backwardation at the front. So, I think those sort of the seeds of a later restoration, but short-term, no, certainly no. Not necessarily certain we've seen the extreme downside, but we are $6 above last week's lows. So there's been some retracement.
Some recovery, absolutely. And as you said, the story of oversupply began to dissipate even before all this tariff talk at the start of the year, really, that this was not going to be a oversupply story this year. In fact, it was more obviously going to be more about demand, really. And Michal, let me go to you on that. Let's talk about demand and China, of course, and what that's looking at from the Chinese perspective. Low oil prices are good for China. Is it stocking up? And also from the tariff point of view, we see a fairly relaxed, defiant China so far in reaction to what the US has been doing. What's the mood there economically, would you say? Not that you're in China, but you're the China expert, yes.
I don't know about relaxed, but certainly defiant. The very positive Q1 GDP news that came in this morning, 5.4% growth, really beat expectations, I think is a boost to the Chinese, which have been waiting to see how the tariffs play out. Now, obviously, there are tariffs on China, but as we've seen, some of them are lifted, some of them are increased. they have been waiting with the kind of any potential stimulus, not that there's going to be a massive stimulus, but with the kind of policy response support, they've been waiting to see how their policy efforts from the end of last year play out. And it seems like they are giving a little bit of a boost to the market. So they've been waiting to see for that. They've been waiting to see if there is any kind of opening for a negotiation with the US, which is still very much uncertain. That also feeds through to any kind of bilateral talks with their partners. We've seen beginnings of discussions with the European Union, but even there, obviously there's a bit of a wait and see approach because nobody knows what, if anything, Trump is going to demand from them in terms of relationships with China and trading activities with China. So they've really tried to calibrate their responses to the US tariffs to be tit for tat, not escalate, and show that China's not going to fold, that China is going to respond, which effectively means that US commodities are not going to China. Sort of very few, there's very little crude oil, very little LNG, that's all being resold and retraded. LPG and ethane, I mean, the petrochemical market is now the big question. So when it comes to demand, we don't know about the market yet. We also have to bear in mind that Q1 in China is always tricky. We've got the Chinese New Year where there is travel, and travel was quite strong this year, but it's very hard to tell the base effects. It's very hard to see, exactly what's happening. Sort of in terms of oil demand, the first 2 months of the year were not great. March imports picked up again. But overall, I think, again, China's responding. We have to wait and see how much and how they boost the domestic economy, but they will do it. They will try and put a floor on any sort of impact of tariffs. But
and what about, and I mean, you mentioned sort of the oil imports haven't been that strong, but why is it not taking more advantage of the prices as they are? Perhaps we're going to be creeping up again soon. So, and China, of course, always buys at an advantage, doesn't it? Have we not seen any activity on that front as a result?
We are seeing a little bit of that, and we're seeing, more appetite for Saudi volumes. There's another big uncertainty in the market, which is what happens to Iranian and Russian crudes, which have been, very big, at least in Shandong province, where the teapots are very margin sensitive and trying to pick that up. But I think there's also a bigger story here that oil product demand in China is falling. And that is structurally a trend that we're going to have to get used to. Gasoline demand is slowing and probably falling because of EV penetration. There's fuel displacement in diesel. If petrochemicals get hit, I wouldn't be surprised if we see China starting to shift more to coal. And so the questions for China are very much on the macro level. The oil industry is humming along, but it's not as, I would say, sensitive at least from the government's perspective, because there is a change there.
Yeah, no, absolutely. And of course, big producers need to watch out for that mood, because especially Gulf producers, obviously, who and others who rely on that demand. Narendra, good morning again.
Hi, good morning.
India must be happy with these low prices, or not? What's the mood there?
Well, low prices are always good news, since we import roughly 89% of our total requirement. And our requirement is 5.5 million barrels a day. So, of course, Indian importers are happy. But really happy, that's the bigger question. In the sense, if oil prices are low, but the world economy is in turmoil, or if there are some serious signs of recession, then of course India is not happy, because our economy is also integrated with the world economy. So we want to see low oil prices. 60 is wonderful, 65 is okay, even 70 is okay. But at the same time, the global economy must be strong, must be doing well. So right now, what is happening, the oil prices may be going southward, but then if there are strong indications that the global economy might be getting into some kind of serious turbulence. So that does really make India very happy, because turbulence of any kind on the global economic landscape is bad news for us, because we want to see stability. We want global economy to be doing well, including that of China. And at the same time, we can have lower oil prices, crude prices. That's wonderful. But we know right now that's not happening. Oil prices are going down for the reasons we all know, tariff wars, etc. And at the same time, we know the Chinese economy is not doing very well, which is a bad news for us. And thirdly, of course, the kind of some highly credible, respected economists are questioning now that, probably world is heading in the direction of, economic recession. We don't know whether shallow or deep recession, but recession nevertheless. So that makes India quite worried. And I wouldn't say give us sleepless night, but it's actually very worrying. Though I personally think it's a bit too early to say the global economy is going in the direction of recession, or there is disruption, of course. And, but at the same time, and of course, some fundamentals are being questioned, especially those of international trade protocols, international business protocols and practices. But we have to see how the world really goes. I mean, can the US live without China exporting to the US? We don't know. Probably not. Can China really, as strong as they want us to believe, the rhetoric apart? Probably not. So it's kind of shadow punching going on from both sides. So one hopes, especially in a country like India, one hopes that reality will dawn soon and they will actually realize that they are not what they think, and therefore it's important to still stay engaged so that the global economy can remain in good health. That's more important for the US than any other country on the planet.
Yeah, I'm sure we'll see some recalibration of what we're seeing at the moment. Thanks, Narendra. I'll come back to you because I wanted to talk about also the Russian oil into India. Paul, just to go back to sort of commodities in general, so you gave us your outlook that there's no equilibrium reached at all. We're still set to see some more calibration. But, in terms of signs from consuming countries such as China, for example, for metals, demand, etc., where are you seeing that? I mean, again, and also in the context of where the gold as well is something I wanted to ask you about. A lot of people are still hedging using gold. We've seen it go up even more this week. People are, one of the banks yesterday forecasted we might hit 3.7 this year in gold, $3,700 again. So where are other commodities in reaction to what's happening on the tariff equation, particularly sort of precious metals as well?
Precious metals are a different story, but of course the risk-off mood has been such that for a while even gold prices fell. I mean, the one remaining safe haven, just simply because people were selling gold to meet margin calls on other assets. So again, not much of an equilibrium. But again, part of this is breaking it down. It's easy to get apocalyptic and global recession. And this isn't a global trade war. This is, if you like, 150 separate trade wars between separate countries and the US. Everybody else is still trading as they were before. And so within that, a lot of the world just carries on before. There are a lot of countries that don't trade much with the US. The interest here is really how much is the US damaging its own demand side and damaging its own supply side? And that comes up most clearly in oil. I mean, a lot of coverage yesterday that the IEA had cut their estimates for global demand growth this year by 305,000. Absolutely no coverage that they'd also cut their non-OPEC supply growth estimate by 210,000, i.e. there's not much of a... and what they're doing is effectively, what everyone's doing is cutting their US oil demand growth estimate and their US oil supply growth estimate. So ultimately on oil, you see that the equilibrium is going to be determined by the cost curve of US shale. Will US supply fall more than US demand? I think it will. US shale is not
certainly at these prices.
Yeah, at these prices, it's already looking extremely weak. It will weaken further as drilling comes down over the next few months, again, assuming that we don't get much of a rebound. So within that, this feels very much a US issue for commodities on both supply and demand side, particularly on the oil side. And again, I think that's why talk of a new range, a new equilibrium, it's far too early, unless it's a new equilibrium where US shale production is constantly falling. And that doesn't feel like a stable equilibrium to me, but that's where we are at the moment. So I think Narendra may be right with his sort of $70 as being sort of somewhere where shale is still just about alive and breathing, but not necessarily moving forward particularly fast. Down at these kind of levels, demand starts going up because it is cheaper. So I think there's a little bit of overdone demand pessimism when in fact we should be pessimistic about demand and supply. It's just not a very stable world when you have trade policy in such a flux.
Of course, and the demand, of course, is good for OPEC producers, isn't it? Because a lot of them, at least the cheaper cost ones, because they're going to see that they're able to keep producing at these prices of below 70, if indeed that remains the case. Mikhail, you mentioned Iran in the context of oil exports to China, where, I mean, we haven't really seen a change there, despite the maximum pressure talk from the US so far. China has continued to take those barrels as far as we know. Do you see that becoming a factor in the negotiations with the US? I mean, you touched on it earlier, i.e. China would be willing to perhaps start taking less Iranian barrels if it was asked to do by the US in exchange for, you know, some give on the tariff negotiations. Is that something, do you think they'd be open to?
I think they'd need to see a very grand bargain. So what the Chinese have been trying to avoid, and perhaps one of the reasons that they haven't called the US and called Trump, as you like to say that everybody else has, is because they're hoping to avoid this kind of back and forth. They want to sit down once and deal with lots of issues. Now, they might not get that. And Iran is probably part of that, not a major part of that. The situation has changed compared to, I think, first time round when the Iran sanctions hit on a number of levels. First, on US-China relations more broadly, that back then there was a lot that China also wanted to salvage in the relationship. And today, I think it's much more structurally pessimistic on where things are going. Back then, also, it was the state-owned majors that were buying most of the Iranian crude. And today, it's independent refiners.
Yeah.
And so, of course, the Chinese government has control. It could control those flows if it really wanted to. It could crack down on some of that trade. But, you know, that sort of low-cost feedstock for a marginal supplier in the market, when they are concerned about energy security, so they have limited incentive to stop. And the market finds all these weird and wonderful loopholes each time with, you know, Iranian flows have come down a little bit. And we've seen concerns about the ports and port activity. And one of the independent refiners that has been sanctioned. I mean, I think right now it's the complete opposite. There's no reason for China to do anything on Iran in support of US policy goals. And it might be one of the things it would give, but it doesn't feel like one of the things that are sort of high on the list of give and take or of ask that both sides have of each other. Having said that, we just don't know. We just don't know what the US end game is here.
Yeah, we just don't know. It seems to be the uncertainty factor there. Narendra, let's talk about India's intake of Russian crude, because of course that in the last 2 years, we've seen a huge swing, haven't we? 2% to 20% of its imports. Now that's gone up and down a little bit in the last few months, subject to pricing. But, you know, and no pressure, we're not seeing any pressure from the US on Russia yet in terms of additional sanctions. Really in practice. So what's India's take on that in terms of what the recent volumes are of Russian crude that you've been taking in, and you know, any outlook for the second quarter on that?
Well, as you know, there are no sanctions by India against Russia. So, I mean, we have independent policy. I mean, there are some sanctions against Russia by some Western countries led by the United States. But we know the United States and Russia are not talking. They're talking Istanbul, they're talking in Riyadh, they are talking everywhere. So, but as far as India is concerned, we just go by economics. Whosoever offers us good, you know, good economics, we go for that. So Russian companies, exporters have been offering good economics, and Indian importers have been buying. So as long as they continue to offer, you know, good discounts and can deliver crude oil at Indian ports, at Indian refiners' ports, you know, they will continue to buy. In fact, the Bombay-based company, Reliance, they have entered into a kind of understanding with Rosneft for 10 years. So they're going to import roughly $10 billion crude oil every year for next 10 years. So that's a big number. So, and the same goes for the other companies also in negotiation. But at the same time, if we can get better deals from the United States, or for that matter, any other country, you know, our refiners are going to buy from them as well. Our strategy is not to put all the eggs in one basket. So we want to diversify the supply side in the sense that buy from as many geographies as possible. So
and
Russia
on the
is offering.
Yeah, Russia's offering. On the refining side, is India continuing to sort of refine that crude and re-export to Europe, as it has been really more or less in the last couple of years? Is that continuing?
Well, you see, India, as you know, we are a kind of refining superpower. In fact, we are setting up 2 more refineries, maybe even 3 more refineries to hold on to that status being a kind of refining superpower. So we import crude oil, from 40 different countries, and we export petroleum products to 106 countries around the world. We have been doing it for years. And, the US is a big buyer. We export, if I remember the figure correctly, something like $6 billion petroleum products to the US alone. And then, of course, to Western Europe. And some of these molecules may be of Russian origin. So, but once it comes to the refinery and, it's converted into petrol, diesel, turbine fuel, and so on and so forth, then it's the Indian molecule because it has been refined here. But that depends on them, how they want to look at it. I think at the end of the day, while we discuss what we are discussing this morning in your show, the fact is that my own understanding is when it comes to oil and gas is one word, and wherever possible, they, despite sanctions, despite, tariff wars and all that, exporters, importers, they try to meet wherever they can, and they try to cut deals and hope that, things will be normal as soon as possible. So that's how the oil and gas sector functions. Politicians might impose sanctions, but when you talk company to company, they're very friendly and warm with each other. And they just want these sanctions to kind of go away as soon as possible. And as for Indian importer concerned, since we don't have any trouble with any of these countries, especially the large oil exporting countries, we are comfortable buying from any country, whichever or whosoever is offer a trade economy. With Iran, we have some issues because we don't agree with Iran's nuclear military ambitions. So we have some disagreements with them, Iran, and therefore sometimes we go along with the US view on Iran, and we don't import oil from them. But if there is some breakthrough between the US and Iran, and those kind of sanctions, disappear, then India will start buying from Iran as well. So we don't have any problem. We have great relations with Iran otherwise. So I think it's
if the price is right.
And, just one last point I want to say that look, when you look at the whole thing from the Western eyes and all that, world look very different. When you look from a country like India and you really look at the world, it looks very, very different. We have a more pragmatic approach.
Thanks, Narendra. There's our survey question today. All markets will recover to a $70–$75 range in the second half of the year. Once the dust settles on final reciprocal tariffs, everyone's saying we still have to sort of see how these full tariffs play out, if indeed the line from the US remains as it is. So will we go back to the range that we've been in previous to these tariffs or not in the second half? Paul, the other question that's sort of rearing its head is inflation again. Because of the tariff talk and the sort of rhetoric around that and what that might lead to. Obviously, if we see trade restrictions implemented, of course, is that we might see higher prices everywhere, especially into the US, inflated prices for all sorts of things. Is that a concern? I mean, again, talk of US recession becoming much more of a reality this year now. Everyone was talking about it last year. It never happened. For a good reason. How nervous are markets that we could see a recession in the US? We've already seen downgrades in GDP forecasts been made in the last month or so. And, stagflation being a threat, obviously, having inflation at the same time.
I think it's in there as concern as to whether the inflationary impact of the tariffs and the deflationary impact of on the economy, which one comes through. And you can see that by the volatility in bond markets over the past week, with again, as disturbed, I think, as sort of any other market. I think one further thing on that is, again, also it's increasing. Regardless of what it does to inflation in terms of consumer prices, it is inflation producer costs, and one of the worst affected, of course, are again US shale. The oil industry is very steel intensive. It needs specific types of steel. A lot of those are imported, and so again, it's another upward pressure on the cost curve for US producers. And so I think all of those effects are working through both macro and micro, but generally you see markets, they don't like uncertainty. Generally, they don't like movements away from free trade. And most of all, what they don't like is flip-flopping in policy. And we just don't know what the policy is because it changes day by day. And again, that's extremely disruptive for all markets. And the debt markets are going to be particularly affected because, again, it just raises questions about the size of US debt and whether other countries are prepared to constantly buy US debt to cover for that. And I think that's where we get into very serious territory, is when the markets start worrying more seriously about US debt and, if you like, even the debt rating for the US.
Well, that's certainly what kicked in last week, wasn't it? That's where we saw a little bit of a break put from the Trump administration once bond markets were reacting. Michal, talking about bonds and US debt, of course, China is a large holder of those treasuries, and can you, I mean, it has already sold off some of those treasuries in the last week or two, but how much do you think it would use that card in its trade negotiations in terms of going forward? I mean, it seems to have a pretty strong playing card there. In terms of the confidence in the US economy, what it could do with
It has
those.
lots of different playing cards, but I think it will use them very, very cautiously, because obviously it also impacts China and the Chinese currency and Chinese goods and global stability. That China is really trying to portray itself as stabilizer, as the partner of choice, as the reliable one in the global economic system. And I think, again, so far, it has really tried to calibrate its responses to the US, not to escalate, not to use what I think would be seen as nuclear options. I think even though, the data has been good so far, the Chinese are extremely worried about the fate of the economy. Sentiment in China is not great, and they, so I think the domestic stability and the domestic economic activity is really the number one priority. It's sort of about shielding external pressure, not about creating new sources of external pressure, to the extent that they can, of course.
And also appearing to be, defensive to the US, right, for internal reasons. I mean, President Xi needs to look strong. How is the property, I mean, talking about internal domestic sort of issues, how, the property sort of build-up crisis that has been, it's still there, but any improvement there? There were a few adjustments made on the government policy side last year to help that sector start to recover. Where is it at as we sort of go into the second quarter of this year?
I mean, slight stabilization, and I think what the government's trying to do is avoid a property crash, because lots of people's wealth are tied into the property sector, but they're not looking to reboost growth there. They're not looking to reinvigorate that. I think that sector is sort of the old China. What they really need to make sure is, again, that it doesn't collapse, but to try and reallocate a lot of the funding and a lot of the financing in China to the new industries, to kind of the industries of the future that are generating growth, activity, not so much oil intensive activity, pretty electricity intensive activity as well, but really trying to reshift the focus. It's about maintaining stability in a world that does not lend itself to maintaining stability. But I think that's kind of the needle that they're trying to thread here.
Thanks, Michal. There's our response. Yes, that sounds like a confident sort of 78% there so far. We'll wait and see. Certainly won't happen if we start to see recession in the US, etc., and this trade sort of rhetoric ratchet up. Narendra, I mean, specifically from an Indian perspective on the tariff side, let me ask you, I mean, are there any particular concerns from India in terms of what's been communicated so far from the US? Any particular products that would be impacted more or less from your point of view in terms of Indian trade with the US? How high is the level of concern there?
Well, like many other countries, of course, we are also concerned. We are a major exporter of services, including IT services. And as you know, a number of American companies have got massive, actually, back offices in India, including ExxonMobil and many others. And they also have manufacturing facilities like Apple, for instance.
Exactly.
Apple, for instance, So, and we also export petroleum products. We export steel and pharmaceutical products, major exporter of pharmaceutical products to the US and many others. So, of course, there are concerns, because whenever you have this kind of disruption at that level and that scale, there are concerns. So right now, when you look at where our concern is that, would, for instance, America now try to dump agriculture products in Indian market? That's a kind of concern for our producers. And at the same time, if American markets, I wouldn't say start disappearing, but creating more problems for China. China may try to dump, engineering products and finished products and all that in markets like India or or a few others. I mean, where else you'll find a kind of size of market that we have in this country, 1.4 billion people. So there are those concerns with regard to both America and China. So, but at the same time, we are a very strong economy. The fundamentals are very strong, and our GDP is roughly 60% driven by domestic demand. So that's a comfort. And at the same time,
what's the recent expectation for GDP this year? Have there been any adjustments to that 7%?
I think to be realistic, 6.5 to 6.7%. I think to be realistic, but it all depends on how the global economy is going to go. If the global economy, gets into some serious turbulence, like shallow recession and all that, or the Ukraine war continues, or Gaza gets out of control, so then we don't know. But we hope that
Gaza is already out of control. Yeah.
Well, yeah.
I'm not sure that's impacting anything anymore.
Yeah, well, it actually does, because as long as this, but who knows if it gets out of control. So further, in the sense, escalating. So those are major concerns, because for us, especially Middle East is very extremely important area. We have millions of Indian workers working there. Our economy is very integrated with the Middle East and so forth. So I think there are major concerns. But if there are, for instance, things remain under control, if president can deliver peace in Ukraine, and Gaza is kind of some efforts and it's kind of contained there, and China and America, they find some kind of space to at least have serious negotiations, then hopefully about 6.65 to 6.7%, maybe even 6.8%. And if we are very lucky, oil prices go further down, global economy does get into recession, maybe even 7%. So there are many questions, because oil price is very important, very central to India's overall economic growth.
Of course, and very essential to producers as well. Thank you so much, Narendra. Thank you to Michal, and thanks to Paul today for joining us on the Daily Energy Markets podcast. There we have an interview coming up in an hour with Cornelia Meyer, of course, a very well-known analyst in this field and in the economic field as well, talking about the tariff situation and what that means for economies and OPEC as well. And a lot of other very useful insight there. So encourage you to tune in. Thanks so much for joining us today, everyone. Have a good day. Bye.